In this video, we're going to be talking about understanding market structure for beginners, how the market is structured, the in-depth structure of the market. Now, when it comes to market structure, there are two main types of structures in the market. So market structure is basically how the market is structured, how the market moves, the basic foundational structure behind the things you see on the charts. That's basically market structure. And there are two main structures of the market. There are two ways the market moves. There's no other way the market moves apart from these two ways that it moves. And the first one is called the trending market. And the trending market is broken down into two things, uptrend and the downtrend. So when the market is trending to the upside, when the market is trending to the upside, we call that an uptrend. And when the market is trending to a downside, we call that a downtrend. So basically, when the market is going up, we call that an uptrend. And when the market is going down, we call that a downtrend. Right? So the second type of structure of the market is called the ranging market, or sometimes called consolidation. Right? So this is basically when the market is moving sideways. Right? So there are three ways the market can go. The market is either going up, going down, or the market is going sideways, right? And everything is to the right side. The market can't move to the left side. That wouldn't make sense, right? So I'm going to be explaining these structures. I'm going to be breaking them down. Firstly, I'm going to be breaking down the trending market, how the market trends, right? So because the market doesn't just go up straight up like a rocket, right? So the market trends in a certain way. I'm going to be breaking that down now. So let's talk about the trending market. Now, if you understand uh, market structure, or if you understand candlesticks that I explained in my previous video. So if you don't know how candlesticks form, you might not understand this when you look at it on the chart. But if you understand how candlesticks form, the market is based off of the structure of the market is based off of a series of candlestick formations. So as candles form, they form a structure, they form patterns, right? So now when it comes to an uptrend or a downtrend, when it comes to a trending market, a trending market is a series of highs and lows being formed by the market. What do I mean by that? So when you look at the charts, when you see the market go up and go down like this, right? And then maybe go like this. So now this here is called a high and this here is called a low. So let's name this high, reduce the length, reduce the size, and then this is low. So this is called a high and this is called a low. Right. Now, an uptrend or a downtrend is a combination of these highs and lows in the market. Now, let me just draw out an uptrend for you. When you see the market go and form a high and form a low and form a high that is higher than this high, than this previous high, and then comes down and forms a low that is higher than this previous low, that's an uptrend. So basically, uh, let me use the arrow. Let me see if I can find that. Yeah. So these are the lows and then these are the highs. Let me change the color of this to red. So this is the low, this is the high, and this is the low. Now a combination of these highs make up a trending market. So the higher the market goes, that's the higher the highs, the higher the lows, right? So if the highs, if you're having higher highs, you're having higher lows, that means that is an uptrend. And then the same thing goes for a downtrend. If you're having lower lows like this and lower highs, this is a downtrend. So here we're gonna put the highs. This is the low. This is the low, right? So you can see that this low is lower than this low, and this high here is lower than this high. So that means the market is going to the downside, right? And then this one is going to the upside because this low is lower than this low, right? And then this high is lower than this high. So that's an uptrend. All right, so just put this in your head. Let me type it down. Where's the text? So just put it down. An uptrend is a series of higher highs and higher lows. So this is the definition of an uptrend: higher highs and higher lows. And a downtrend is a combination of lower lows and lower highs. So a downtrend is a series of lower highs and lower lows. So this is basically a downtrend. An uptrend is higher highs, higher lows. Downtrend, lower highs, lower lows. When you look at the charts, try to identify these characteristics: higher highs and higher lows, and lower highs and lower lows, and then you know if the market is trending to the upside or to the downside. Now, to explain the ranging markets or consolidation, that one is quite different from the uptrend and downtrend. And we know that is a sideways movement. So if the market forms higher highs and higher lows to go up, and then forms lower lows and lower highs to go down, that means if the market wants to go sideways, what will happen? Well, what would have to happen? It means the market will have to form equal highs and equal lows like this. So if the market forms equal highs and equal lows like this is basically a ranging market. That means the market is just going sideways. It's not going up and it's not going down, right? So this is what they call consolidation. Market is just choppy, it's just going sideways, right? It's not going up, because an uptrend is higher highs and higher lows. Downtrend is lower highs and lower lows. A sideways movement is equal highs and equal lows. So let's write that down. A ranging market is a series of equal highs and equal lows. Where's this? Equal lows. All right, so this is what a ranging market is. It's also called consolidation. Most people call it consolidation. I call it consolidation too. So let's see. So this is an uptrend. This is an uptrend. This is a downtrend, and this is a ranging market. Right. So those are the three main structures of the those are the two main structures of the market, basically: trending market and the ranging or consolidation market. Now, when it comes to the trends, there's something you need to know about the trends. So when you have a downtrend, for example, this is a downtrend, right? Because you have lower highs and lower lows, so the market is trending to the downside. That means the market is going down. This these structures here, these up movements in this downtrend, it has a name, and it's called pullbacks. These are called pullbacks, where the market is pulling back against the trend, because the market doesn't just go straight down. You won't see the market go down straight like this, like a waterfall. The market goes in steps, right? So imagine this is a step, right? So each step like this. So these structures here are called pullbacks, right? And if you change it to an uptrend, the same thing goes, the same thing works, right? So this is also called pullbacks. So the market is pulling back. So what basically happens is you see an up move like this, and then the market will pull back a little bit and then go up higher, and then pull back, go up higher, pull back, go up higher. And then a downtrend, market will push down, go pull back up, push lower, pull back up, push lower. Right. So those are called pullbacks. So whenever you hear someone say pullback, this is what it means, basically. So those are the structures of the market. Let me just show you a couple of examples here on the charts. So let's go to GBP USD. Let's go over here. Let me delete this, turn this off, and also turn this off. So now that we're on GBP USD, we're on the 1 hour time frame. Let's try to identify those highs and those lows. And let's try to identify an uptrend, a downtrend, and a consolidation market or a ranging market. Now, what do we have here? We see that this market went all the way up, right? It went all the way up. So if this market is trending to the upside, what do we have to see? What do we need to identify? We need to identify the highs and the lows, right? And what you're going to see is you're going to see higher highs and higher lows. So let's basically start from here. So this is a low, this is a high, and you can see this high, this is a low, higher low. This low is higher than this low, so this is now a higher low, and we're looking for a higher high. This is a higher high because you can see this high is higher than this high here, so this is a higher high, right? And we can see this low again, this is a higher low, and then we have another higher high. So you can see this is a low, high, higher low, higher high, higher low, higher high, right? So if you also change this to a line chart, you can, I think you can see it, right? So you can see, let me just clear this, okay? So you can see low, high, higher low, higher high, higher low, and higher high. So that means the market is trending to the upside. Now, if you continue, you can see that the market keeps on forming those highs and lows. You can see this is a low, and this low is higher than this low here. And then what do we have? We extend this box, this high. You can see the market forms another high here, which is a higher high, higher low, higher high, higher low, higher high, higher low. And then the market continues like that till it begins to form a downtrend. And then this is a downtrend, right? You can see the market is going to the downside. Then what do we have there? We have this low, then we have this high. And guess what? The market comes down and breaks this low. So this is called a break of structure. What that basically means is if we know that the structure of an uptrend is higher highs and higher lows, that's the structure of an uptrend. A break of structure is when they break this structure of an uptrend. So basically, if they form a low and they form a high, what do we expect? We expect a higher high, right, and a higher low. So now we expect a higher high here. If we expect a higher high here and they don't give us that higher high, but they give us a higher low, and then go and break this low that is just formed, that means that's a break of structure. They have broken the structure of an uptrend. That means they are now beginning to start a new structure, which is a new structure for a downtrend. All right, so if you have an uptrend and they break structure, that means you're about to enter a downtrend. And if you have a downtrend and they break structure, that means you're about to enter an uptrend. All right, so here we have this uptrend going up, and then they break structure, they break this low, right? They went lower. So now we have what? We have a lower low here. And wait, guess what? We have a lower high here, and then we have a lower low here. All right, so that's this is an uptrend, and then this is a downtrend. Right, so let's see if we can find a sideways market. I think to find that, the easiest way to find that is to go on the 15 minutes time frame. So here we have a sideways market here. This is a sideways consolidation. Why? Because we have this low here, we have this low here, we have this high, we have this low, we have this high, and this high is almost equal to this almost equal to this high, and then we have this low here, which didn't break this low, and then we have another high here. All right, so what is basically happening is this is an irregular movement, just up down, up down, up down. So this is basically sideways movement. Let's see if we can find another one here. Yeah, so this is a good example here. So we can see we have this low, and this low is equal to this low, and this high is equal to this high. So that means the market is moving sideways. Right, so if you draw a line, or if you draw a box, I like to draw the boxes, you can see that this is just sideways movement. The market is just going up, going down, going up, going down, going up, going down, right? So it finally goes out of that range, out of that sideways movement. Right, so this is basically the structure of the market. This is how the market is structured. So let's do a quick recap. So we have an uptrend, we have a downtrend, and we have a ranging slash consolidating markets. Right, so this is an uptrend, downtrend, consolidating markets. Now, an uptrend, what does it look like? We're gonna have a high, a low, a higher high, higher low, higher high, higher low, and higher high. That's an uptrend. A downtrend consists of what? Series of lower highs and lower lows. So we have a low, we have a high, we have a lower low, lower high, lower low, lower high, and eventually a lower low. Right? So, and the ranging markets, what do we have is a series of equal highs and equal lows. So what we're going to have is we're going to have a high, we're going to have a low, we're going to have an equal high, an equal low, an equal high, an equal low, equal high, equal low. So this is an uptrend, a downtrend, and sideways movements. So ranging markets or consolidating markets. All right, so I hope you found this video helpful, and what you have to do now is the assignment I want you to do now is go on your charts and look for these structures, look for an uptrend, identify it, take screenshots, also look for downtrends, take screenshots, look for ranging markets and take screenshots. Because if you don't practice this, if you don't try to look for this on the charts, you will never see it. So you have to be able to see it in the past before you can see it in the future. You have to be able to see it in hindsight before you can see it in foresight. So look for this on the chart, take screenshots, and also if you found the video helpful, click the like button and subscribe, and I'll see you guys in the next video.